I'm Taylor Riggs in San Francisco and for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, a face-off with Facebook. The social network is sued by 4 potential competitors who accuse Facebook of anti-competitive behavior. Details and what's at stake with the co-lead counsel in the case. Plus, the ultimate engagement. Twitter CEO Jack Dorsey asked Tesla CEO Elon Musk for tips. We'll explain. And retail and returns. Making the return of a merchandise a more customer-friendly experience. That's the goal of Returnly. We'll talk to the CEO as part of our Retail Transformed series. But first, to our top story. Now, 4 potential competitors are demanding that Mark Zuckerberg be forced to give up control of Facebook. In a lawsuit, they accuse Facebook of anti-competitive behavior. They also want the social network to sell its WhatsApp and Instagram assets. Facebook says the claims are without merit. To discuss, we are joined by Yavar Batahi, partner at Pierce Bainbridge and the co-lead counsel in the case. Great to have you.
Thanks for having me.
Wanted to break down some of this piecemeal. First of which, I wanted you to talk about the lawsuit wanting Mark Zuckerberg to be forced to give up control of Facebook. In your opinion, is this even possible, and why?
Well, as is now, he has incontestable control over the company. His class of shares overpower the Class A shares. He has carte blanche to do what he wants with that company. He has control over the board. And when you look at the details of our lawsuit, the anti-competitive scheme was hatched and executed and at times commanded straight from him. And there's no reason to believe that if he divested a few of Facebook's key assets here or there, or awarded damages, that you would ever fix the more systemic problem with the markets that have been caused. You have great distortion in the markets, and he's at the center of it.
So I want to talk about some of those distortions that you mentioned, one of which is or the lawsuit is alleging really that they'd like WhatsApp and Instagram to be spun off or sold off from Facebook. What is the antitrust argument there?
Well, what's happening now, according to a lot of major news sources have reported, including Zuckerberg on his blog, that they are rapidly integrating WhatsApp, Instagram, and the core Facebook products. And the reason we've moved very quickly to bring this suit is that once that integration is over, it'll be impossible to break this up. It'll be impossible to take the giant amalgamation of data that integration will create, that back-end integration, and sort of put the genie back in the bottle. It's not just the data. The real issue is that right now the markets are somewhat segmented. WhatsApp has a global presence. Facebook's other products are more US heavy. When their backends are integrated, these products can communicate with each other. And essentially, you'll have 2 billion people in one giant social network. And at that point, we don't think a normal remedy will fix things.
So then how did this even get approved when all of these deals are going through in the first place?
Well, what's interesting is how regulators think of competition, and sometimes it can be a bit formalistic. At the time, I think they didn't think of an app, a third-party mobile app, as a competitor of a social network. But in reality, what they're competing for is that user engagement and the social data that comes from it, which is why a messaging app is a direct threat to Facebook, because people use it, interact with it, and you get that data that you can then use to target content and sell advertising. And that's what they're all vying for. And so what a regulator will often do is say, well, these two do very different things. They're not in competition. But now we know, and we know from Facebook's own documents that were published on NBC News, that they did very much find things like dating apps and messaging apps to be in direct competition with them. And so when a regulator looked at this, they probably didn't have the sort of view of the markets that would tell them that they were wading into incredibly concentrated markets.
I think one of the issues here is you have a lawsuit coming by 4 smaller competitors. How do you make this seem that it's not just 4 small competitors angry at the bigger guy's market share?
Well, the first thing to mention is, you're always going to have a monopolist extinguishing things as early as possible. And we don't know what they would have been if Facebook didn't pull the rug from under them. I mean, some of them were chat programs and messaging programs in competition with Facebook. There was a dating app, and now we know Tinder is this massive success. And we really don't know what would have happened if Facebook didn't sort of choose sides. A lot of what we're alleging is that when Facebook pulled core APIs out of its platform, and it decided this in 2011, it then let developers think that their platform was stable for 3 years before they even made a peep that they were going to pull it. And then while they did that, they targeted the ones they wanted to win, the apps they wanted to win, and they asked them for their most sensitive data. And so what happened was the distortion occurred at the time my clients were competing. They never had a chance. And so, their size, I wouldn't think is very dispositive. I mean, the second point I want to make is we're proceeding as a class because Facebook checked, and found that 40,000 apps were affected by its decision, and 1,000 of the top apps had, I think 80% of them were going to be affected by the decision. And so, if we can establish liability for at least 4, we're establishing them for everyone that's hurt. And if anyone else is hurt, then they should do it. They should bring the suit now. So. Well,
thank you so much to Yavar Batahi. I appreciate your time, and I do want to just bring you Facebook's statement that we're getting. Facebook, of course, responding, saying that we operate in a competitive environment where people and advertisers have many choices. In the current environment where plaintiffs' attorneys see financial opportunities, claims like this are not unexpected, but they are without merit. So we will bring you more on the case. And I do want to, on this point, bring in Bloomberg Technologies' Kurt Wagner and Jitendra Worrell of Bloomberg Intelligence, because both of you are here with me as well, covering Facebook from multiple different angles. Kurt, let me start with you. From the Facebook perspective, what appears to be the bigger threat? The part that perhaps people want Mark Zuckerberg maybe to lose some of his big controlling stake, or this more threat against some of this anti-competitive behavior?
Well, they're a little bit one and the same in the sense that Mark Zuckerberg's control is what has led to a lot of these potential problems, or at least that's what critics would say. It seems unlikely to me that they would be able to take away his control, considering he's the guy who has all the votes. But I think a bigger risk is that they actually were to split up Facebook. I don't think that this is going to happen, but that would obviously be a devastating thing to the business, right? Instagram is a huge part of Facebook's current revenue, and WhatsApp, Messenger are considered potential revenue, and a big part of the reason that people invest for the future of the company.
Jitendra, fold into your world of fundamental analysis. Do investors care? You get a lot of these sort of smaller lawsuits coming their way, starting to hit the company. Is this a threat, really, in any sense? Yeah,
we kind of saw that really over the last year. When you actually look at the valuation of the company, you look at the expectations for 2020, they sort of came down. Earnings actually came down a lot more, and some of these valuation and expectation metrics were sort of reflecting, regulatory issues and pressures like that. As far as a breakup scenario is concerned, I mean, our antitrust analyst continues to see low odds of that happening. But even if that does happen at some point, we have to think about some of the parts and how does that impact investors. And that's where there's some comfort, because if you actually look at these properties standalone, their value standalone would be higher than what it's represented at the moment.
Well, and I want to come and take a look at a chart here that I'm showing inside my terminal, because we're looking at the PE ratio, and you were right. We've heard this from Michael Levine of Pivotal Research, for example, that the valuation of Facebook was really cut in half. Not cut in half, I should say, lower than perhaps some of the other competitors, given some of the news around them. Where do they stand, Jitendra, in some of the antitrust cases? I'm thinking the DOJ, the FTC, if that really does present a headwind on the stock, in your opinion?
So if you look at the expectations on the expense side, where you saw expenses weighing big on the valuation last year, Q3 guidance that they gave for 2020 was very aggressive, $54 to $59 billion in cost and expenses. So they're sort of preempting some of these worries, if you may, for 2020. But what's important for this year for Facebook from a fundamental standpoint is the expectations are reasonable. They are low, 22% revenue growth. That's in line with what the marketeers that we have been talking to are expecting next year. It's on the top of their list in terms of increasing ad budgets among the other players out there. And also Facebook's future is increasingly looking beyond advertising. We are thinking e-commerce, we're thinking augmented reality, payments, not talking about Libra specifically, but payments with what they're trying to do with WhatsApp. And we saw them sort of walking back from WhatsApp ads as well. That opens sort of doors for business services and payments that they're trying to do in India, for example. So diversification beyond advertising is not really captured in expectations for Facebook's long-term growth. So what we are seeing is this year, if they sort of come out and show progress on any of these fronts, then that'll change the story and the narrative for the next couple of years.
Kurt, react to that, because we've been talking about WhatsApp and the payments and perhaps that being a way to get into some other business opportunities.
Yeah, I mean, this has been the discussion around Facebook for a number of years now, is can they figure out a different business line than just ads? And they've clearly shown that they can make advertising work very well for them. But Jitendra mentioned e-commerce with Instagram, I think payments with WhatsApp and possibly Messenger. These are big opportunities. One of the things WhatsApp is doing now for businesses is basically trying to serve as the connective tissue between businesses that may not have a website or other types of software systems to send, receipts via email, right? What if you receive your receipt via WhatsApp message and you can charge the business for that kind of relationship? And so this is what I think Facebook envisions as kind of a diversification. But again, we've been talking about this now for a couple of years and they haven't really hit on anything to date. So that's why, they are such an advertising heavy business.
Yeah, well, and most analysts think that they are poised to continue to benefit from that as well going forward into 2020. My thank you to Jitendra Worrell, Bloomberg Intelligence, and Kurt Wagner. You will be sticking around with us in the next segment, because coming up, Twitter's Dorsey has a new advisor, and it is Elon Musk. What would Tesla CEO, who's also one of Twitter's most controversial users, do to fix the platform? We will find out next. This is Bloomberg. Twitter CEO Jack Dorsey wants to know how he could improve the social network. And who did he go to for advice? Elon Musk. At a Twitter offsite meeting in Houston on Thursday, Dorsey spoke to the Tesla CEO in a video call in front of thousands of Twitter employees. He asked Musk to give some direct feedback. Here to tell us more about Musk's advice, it is Bloomberg Technology's Kurt Wagner. And before we get to the advice, I have to ask, how does this all come apart where you have Elon Musk on a video screen live in front of Twitter employees?
It's kind of a fun story, right? So Twitter, as you mentioned, was at this offsite in Houston, global offsite. They flew all of their employees in. And Jack Dorsey, from the video I saw, looks like he pulls up what looks like an iPad, and he literally FaceTimes up Elon Musk. They have some actual issues getting the audio to work, and eventually, voila, they're talking. Musk's face is on this big screen above Jack Dorsey's head, and the employee base are watching.
So what's the advice?
The advice is, hey, you should do a better job of identifying real people on Twitter versus bots or I guess fake users on Twitter. He said it can be really hard. He has almost 31 million followers. It can be really hard to get real feedback. Are people who are complaining actual customers? Are people who want issues with Tesla cars? Are those people just bots? Are those competitors? What is that? And when you can't tell a bot from a real person on the network, it can make things difficult.
And that does seem to be a broader issue at Twitter. I feel like a lot of the hate mail, for example, that we get, a lot of the negative, the trolling comes on Twitter. I don't get as much of that on an Instagram or a Facebook. How has Twitter not been able to control that perhaps as much as some of the other social media companies?
I mean, this comes back to real identity, which is the term Facebook uses all the time, because they say, hey, in order to create a profile, it has to be your true self. You got to use your real name. You got to use a real photo. And if they believe that you're not your real self, they'll actually ask you, hey, send in a driver's license, prove you are who you are. Twitter doesn't have that. And that's part of what makes Twitter, kind of fun, right? Is that they have these anonymous accounts that can be really funny. You can have parody accounts, but it also creates a real opportunity for people who want to be hurtful, who want to be trolly, who want to be negative, because they can just hide behind any email or username that they can get their hands on, and it's hard to police that way.
You know what? I wanted to ask you, give me your quick thoughts. Twitter in 2020 versus Facebook for the advertising market?
Well, I mean, there's no comparison, really.
Yep.
Facebook is in a league of its own. Well, Facebook and Google are way up here. Twitter's way down below. I think it will. I don't see them coming much closer in 2020, unfortunately, for Twitter.
Always a good, flexible conversation with Bloomberg's Kurt Wagner. Thank you for joining us. And coming up, why Verizon decided it's time to stop its bundles and contracts. We'll hear from the CEO, Hans Vestberg, next. This is Bloomberg. In the streaming era, cable companies struggle to adapt to the new normal of watching content. But Verizon believes it has found a way. On Business Week Talks, Bloomberg's Carol Massar and Jason Kelly spoke with Verizon CEO Hans Vestberg on how the company is staying relevant. Take a listen.
In a network as a service as we have, of course, we sat down and thought about what do our customers want to have and what companies are resonating with our values and would really make something. Remember, we have the best network, we have, I would say, a fantastic brand, and we have a distribution that nobody else has when it comes to customers. That's what we come to the table. So I think that we can partner with anyone.
So these top tier customers, right, get free access, whether it's Apple Music or whether it's Disney. What's the payoff for you? What are you seeing? And are there more partnerships coming?
I think, first of all, the model we have is on the Disney Plus and Apple Music. You get it for free from the beginning, and then we turn them into paying customers. And of course, that model is that we have a lower cost in the beginning, then we get something back when they get paying.
Right.
And we now know how many of our customers will be turning around because we have so good understanding of our customer base who wants it. So that's how we do it. And of course, yes, it might be more, but I will do it exclusive. I will only do it with brands that I really believe that is sticking up to our values as well as for our customers.
Talk about the Amazon deal. We talk so much about the cloud and Amazon Web Services. What does that enable you to do?
This is extremely exciting. I mean, we spent almost 1.5 years with Amazon to do this. So just to understand what we're doing with Amazon, we are bringing the cloud service out to the edge together with 5G in order to give super low latency, enormous throughput for applications being developed by developers. This cannot be done. This is the first time in the world where we have seen that partnership. Amazon couldn't have done it by themselves because they don't have wireless 5G. Verizon couldn't have done it by itself because we are not in cloud service. We don't have cloud software. The combination of us can create something that is so transformative that today you basically, as a developer, you can click on our first 5G Edge site in Chicago and start developing an application for 5G with low latency and enormous throughput. Of course, it's a transformative, and of course, we're one site right now. Think of us have hundreds of them, maybe thousands of them over time, where you have big data centers, maybe less than 10 in the country. We can then give 5G experiences of low latency. And low latency is basically you ping up to the internet and get the facts back. Autonomous cars, real-time AR, VR, artificial sort of intelligence, all of that can be at the edge. And we have just seen the start of it. So that's why we're so excited about this partnership and what we launched in December, 3rd of December last year.
That was Verizon CEO Hans Vestberg. And now 5G. It is also the focus of a new push by Senator Mark Warner of Virginia. He wants to create a Western version different than that offered by Huawei. He joined Bloomberg earlier today with Chief Washington correspondent Kevin Cirilli. Take a listen.
5G and the issue of Huawei has been, over the last year plus, a bipartisan issue. This is one area where there's a lot of us that are in agreement with the administration. We have to prevent Huawei from dominating the 5G marketplace. And if we simply allow the market to play out, they'll end up with 60-70%. What we've not been able to offer our allies and even small telcos in America that purchased Huawei is, even if you're convinced Huawei is a national security issue, what is the alternative? China has put up close to $100 billion to back Huawei, which has got pretty good equipment. It also allows them to then price that equipment not on a market basis and offer enormously attractive financing plans. What we have to somehow get is over the next 5 years to the next generation of telephony and what's called Open Radio Access Network, an ORAN network, we, in our legislation, would put up over $1 billion to support that kind of development and that kind of international effort to finance the ability to go head-to-head with Huawei.
Where does the money come from? Because taxpayers want to know that.
This money would come from an auction of certain spectrum that should be, again, allocated to 5G. Currently, there are a series of satellite carriers that have this spectrum. We have to get them to give up that spectrum, and that legislation is also moving forward. And then the proceeds, some of the proceeds would go to build out broadband. Some of this would to say, how do we develop a Western, not just American, but Western alternative to Huawei over the next 5 years? We believe that will be an O-RAN network. In the meantime, we've got to do more to shore up those competitors to Huawei, the Swedish company Ericsson, the Finnish company Nokia, and the Korean company Samsung.
You know, I'm struck by this because right now Germany has a tough decision to make. China's trying to make inroads in German markets. They're pushing Huawei hard, and the Germans haven't decided. So what's the U.S. message to European allies?
Well, not only Germany, but our closest allies, the Brits, are making this decision as well. They have Huawei equipment. I think most of their security apparatus realize it's not a good long-term solution to have your whole network dependent on 100% on a pure Chinese supplier, and particularly a supplier like Huawei that has such close ties to the Communist Party. But what you have to say to the Germans or the Brits or others is, all right, what's the alternative? Will that alternative be able to compete in terms of not just 5G, but 6G and next generation technology? And can we move this away from kind of a single stack, single provider to a more open-based, software-driven systems? That's where the West can compete. That's what O-RAN will build us as a bridge to. And the fact that our government with this legislation would make that kind of down payment that I hope would also spur other development from other Western nations who don't want to rely on China.
Timetable, end of the year?
My sense is this is the kind of legislation that needs to pass sooner than later, because until we have a plan, not just coming out of America, but for the West writ large, Huawei's going to continue to win.
Before the election?
Absolutely. Has to be before the election.
And as McConnell said,
every month that goes on, another country, because they don't feel that if there's a viable Western alternative, there's no American provider already, but there's not even a viable Western alternative, is going to turn to Huawei. If we can put together the kind of organized plan, I think the West would sign up, and I think we could actually stop what would be a major national security issue.
That was Senator Mark Warner of Virginia. And coming up, it's our Tech Week in Review. We look at what Phase 1 of the U.S.-China trade deal means for tech companies' bottom lines, Peacock's entry into that crowded streaming space, and Amazon receiving a less than warm welcome in India. All next. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. After 3 years in the making, the U.S. and China have signed Phase 1 of their trade deal. Earlier this week, President Trump and Chinese Vice Premier Liu He put pen to paper for a deal that the president claims will have a significant impact on the tech world. To talk about Phase 1's completion and all of the other top tech stories of the week, we're joined by Dan Flax of Neuberger Berman, and also with us, Bloomberg Technology Executive Editor Tom Giles. Tom, in your world, what changed on Wednesday with the signing of Phase 1?
Just enough to keep the technology industry interested, right? A lot of the stuff that's been most vexing for the technology industry remains in place. Tariffs, restrictions on trade with Huawei, for example, which have proved very problematic for many within the technology industry, are still in place. And there's he's left us in suspense for many, many months. That said, there were changes on intellectual property, like the alleged theft of IP that the U.S. has long accused China of doing. There are going to be some limits around that. So there was some progress made, and that is something that the technology industry can take some encouragement from.
Dan, your thoughts on if we got enough concessions on issues regarding IP theft, forced tech transfer, the likes of that?
Taylor, I think it's a reasonable start, but I think we all appreciate that there's a very long way to go. But if we step back and just think about what's going on here, then this century is really going to be marked by enormous change in the in the technology arena, which really has ramifications across economies, societies, how people live, work, play. And so part of what's going on here, in my view, is that both the US, China, obviously other nations realize the importance here. And so from a company and an investing standpoint, we continue to focus on companies' abilities to innovate and deliver value to their customers. If they're able to do that, even in the face of what is likely to be continued tension between these two countries, I think there's still room to create a lot of value.
And Tom, as you take a look, you'd mentioned Huawei earlier. Steve Mnuchin earlier this week said it won't be a chess piece in the larger trade fight. Is the technology sector at least happy that Huawei is being treated as a separate national security issue and not being folded up in the trade fight?
The question that a lot of people have in the technology industry is just how much of a national security threat Huawei really is. And are they on board with the administration's stance? A lot of technology companies that want to still sell to Huawei are finding ways around the limitations. A lot of companies that want to buy from Huawei also are saying, look, we think that technology that Huawei is making is low cost and it's the most reliable. It's what we need, it's what we want for our 5G networks. So I don't think that there's a widespread consensus across the technology industry that Huawei represents a significant enough national security threat. I don't think that they're buying the argument as forthrightly as the U.S. administration wants to put it across.
Dan, I want to switch to another big story that we were watching this week, and that is Comcast Peacock has now entered the very crowded, already crowded streaming space. In the midst of all the crowd, how do they stand out in your opinion?
I think Peacock's a good offering. We'll certainly see how they get traction in the months and the quarters ahead. I think it really speaks to the change in the video landscape in terms of the bundles, the traditional bundles going away, and really consumers are getting a lot more choice, and that's good. In terms of Comcast or Disney or Netflix, really all of the players here, the key is really to develop differentiated content, have closer relationships with your customers, and we think there's certainly room for more than one company to be successful over the next few years.
Tom, let me talk to you. As you take a look at the crowded space, there's free, there's some pricing models, $5, $4.99 with ad supported, there's ad only, there's subscription only. What do you feel right now, at least, is sort of the best method as you take a look at Netflix, which is subscription only, and other companies that have some ad support?
Well, I think what's going to really benefit, you asked my colleague what he likes about it. I think what's interesting is the flexibility in pricing. They've come in with all of these different tiers. Are you going to be willing to watch some ads? There are a lot of people who want entertainment and are willing to sit through ads. All the way up to a much more premium subscription. Also remember, Comcast's millions of subscribers are also going to have access to this without there being a big barrier, another price tag. I'm a Comcast subscriber. I'm paying hundreds of dollars a month. I don't want to pay more for this service, so it's going to be great for them to have people like me who are already buying the service, buying Comcast. They're already going to be able to say like, well, these people are users. A few months down the road to show that they've made actually a lot of traction vis-a-vis the Netflixes of the world.
Dan, I finally want to get some of your other thoughts on another big story this week, and it was Amazon trying to make some inroads in India, but they're just being greeted with a lot of protests and some anti-Amazon sentiment. If India is such a large market, though, for Amazon's future growth, how do they start to make some inroads over there?
I think it's a multi-year journey. I think what the company has been doing so far makes a lot of sense. They're clearly going to be investing for several years, and the importance, if we think about what they're doing, I think is partly around Prime. And so if they're able to deliver a great experience in terms of getting their customers goods and, of course, increased content, then that can be a compelling offering, similar to what we've seen in other places, notably here in the U.S. and other parts of the world. So I think Amazon is doing the right things there. I do expect this to be a multi-year journey for them, but we think it's an interesting part of the investment story.
Well, thank you to both Dan Fox of Neuberger Berman and Bloomberg Technology Executive Editor Tom Giles. And coming up, taking the rigmarole out of returns. We'll talk to the CEO of Returnly. This is Bloomberg. Robots in stores, social media commerce, and the great chase to beat Amazon at its e-commerce game. Those are among the big retail tech trends for 2020. AOL co-founder Steve Case weighed in earlier this week.
Amazon's pretty well positioned, although Walmart and Amazon are really duking it out. Obviously, they have different strategies, but they're starting to converge. One was physical, the other was digital. Now both are doing more of a bricks and clicks kind of strategy.
If the point of purchase is easier than ever with technology, what about returning an item? In our series called Retail Transformed, we look at how tech helps with the return process. Joining us is Returnly CEO Eduardo Villar. Great to have you. Tell me more about your business.
Thanks for having me, Taylor. Returnly is an online returns platform that leverages financial technology to deliver the best returns experience to shoppers.
I wonder, as you take a look at when people return an item, do you get any sense of the gauge or the health of the consumer? If they're returning more, does that tell you anything?
Well, the first thing is that we believe that returns is fundamentally broken, right? Shoppers have to wait on average 4 to 5 weeks to get a refund. And at Returnly, we fix that. We give shoppers returning products their credit immediately so that they can buy again the right item and get it before returning the wrong item. We do take a look at consumers and shopper behavior to make sure that the right recipients get the credit.
How is the health of the consumer? We just came off some weak numbers from Kohl's, from Target. We're waiting some Walmart numbers. Generally, as you look across, how healthy does the consumer feel at this point?
Well, we do work with online brands, and for the most part, online commerce is growing phenomenally, right? So when you look at online return rates, those are tripling the average offline return rates, which makes Returnly like a very good fit for these fast-growing brands.
What are some of the shifts that you've noticed that technology has contributed to in the retail landscape?
Well, for one, Steve is right, with Walmart and Amazon crushing it. The good news is that direct-to-consumer brands have a very good opportunity right now to outsmart Amazon and Walmart doing some of these reverse logistics shopping experiences by partnering with companies like Returnly and other direct-to-consumer technologies like Shopify, Affirm, or Klaviyo. They can get to a point where the shopping experience that they're offering, it's pretty much in par with what Amazon Prime can offer.
Are you seeing some of the traditional retailers having to shift the way they do business to cater more to that e-commerce online customer?
Absolutely. So modern shoppers' expectations have shifted towards like immediacy, right? Everybody wants everything right away. We call them the now customers. And instant gratification is driving that tendency. So we see how brands are kind of like need to level up to meet these shoppers' expectations at the point of return.
I want to get back to your business model. How does the current model that we have in terms of the customer making a return different? How is it not sufficient enough? How does that lead to a more poor customer experience?
Yeah, first off, we don't believe that brands are doing anything malicious towards stopping shoppers from returning online. We just think that they're not very well equipped to map to these new modern expectations. So the way that we help brands offer this amazing shopping experience is by giving customers the opportunity to use their merchandise credit to buy again before returning the wrong items. And that results in customers getting the right items and then returning the wrong ones.
And is that where the immediacy comes from? You said that this is the customer of now.
Yeah, we believe in instant gratification and access to free credit. And when you do that, that is good for the business and it's good for the shopper. We are seeing that consumers on average are choosing to buy again immediately and are outspending their return amount. So, this results in very positive economics for brands.
You've been the CEO there for about 4 years now. What have been
Correct.
some of the early results that you've seen?
So the first one is the validation that this vision of instantaneity around order returns made sense. So we've seen both brands adopt this technology massively, and also consumers reacting very positively to it. We have a 92 CSAT score, which measures the customer satisfaction after the returns experience, which is super high up compared against, folks like Costco or Amazon that are only scoring 84.
Who were some of your customers, your clients?
We do work with fast-moving direct-to-consumer brands like Everlane, Untuckit, Outdoor Voices.
Finally here, I want to talk to you about given you have such a gauge on the retail sector, on the health of the consumer, what do you think is next for this sector as you look out the next few years?
So we've seen the world dividing in two. If you want to buy something that's more transactional, you would go to Amazon. And if you truly want to engage with a brand and have more of an experience, you would go to a direct-to-consumer brand that is offering you a set of flavors, not just the transaction of the purchase. So we see how the world is just splitting in two. And it's all geared towards the best shopping experience. So fun times ahead.
Well, I might be the customer now that you're talking about. That was thank you to Eduardo Villar, the CEO of Returnly. Appreciate it.
Thank you for having me.
And still ahead, Super League Gaming is headed to China, teaming up with Chinese conglomerate Wanda Group to bring esports to a growing market. We'll bring you our conversation with Super League CEO Ann Hand. Stick around. This is Bloomberg. Esports is on its way to becoming a billion-dollar industry, and Ann Hand wants in on the action. Her company, Super League Gaming, is teaming up with Wanda Group to host live events in China, the world's largest gaming market. The alliance will allow Super League to put on video gaming tournaments in more than 700 movie theaters owned or operated by the Chinese conglomerate. Hand sat down with Bloomberg's Sherry An and Heidi Stroud-Watts this week.
What Super League is all about is bringing technology, and when you marry that up with a real estate infrastructure like Wanda, we can now mainstream esports. So 2.5 billion gamers on the planet, about 1 billion of them are sitting in China. These are everyday competitive gamers. And so we're talking about their 700 plus theater footprint, their greater mall footprint, and all the ways that we can bring competitive esports leagues to all gamers around the world.
Investors haven't been too convinced on your growth story as of yet. We have seen the stock price plunge more than 70% since you listed. So will this alliance have a material impact on your future performance?
If you think about it, I mean, we are right now still very much a micro-cap company. We're in a completely nascent space where a lot of people have questions about how will it monetize? Is it a fad or a niche? And what I often encourage investors to do is kind of take away the word esports, right? Because it sounds like a new word and therefore a new category. And it is very much so, but we're talking about the fact that 50% of gamers identify as competitive, so that's 1.3 billion. That 69% have said that they would love to game out of home, no different than I used to go to the arcade as a kid, right? I wanted that social experience, and yet it's a digitally native audience, and they don't have that yet. So I think a lot of what's happening right now in the stock market is just the fact that we are small cap. It's a little bit of like the supply and demand challenge, and just educating the market space about how this really is a primary way that Gen Z and millennials want to spend their time. Right now, millennial gamers spend about $117 a month on gaming content. And the crazy part about that is almost $40 of it isn't even on their own gameplay. It's on paying to watch other people game. And so when you start to understand that share of wallet and all the opportunities to now give them this esports experience that they crave as a competitive gamer, we see that the market space is much larger than anyone can predict.
And how do you convince advertisers and other partners and businesses then to recognize that return on investment? Because it sounds like you're saying this huge drop in the share price is significantly tied to a perception issue or a PR issue for the industry.
When you look right now, most of the esports investments you've seen, almost all have been private. They have been mostly at the pro, league, and team level. Very large valuations, and again, early days on how to monetize it. What we found with brands early on, even the game publishers themselves, is that early on, you know, it's kind of sexy and exciting to focus on the pro level. And now that everyone's become more comfortable with the fact that gamers aren't growing out of gaming, this is more of a lifestyle trend. Increasingly, it's multi-generational. All of a sudden, we find that brands are coming to us and saying, hey, I've done my investment at the pro level, but now I want to reach the masses. I want every gamer to aspire to be a pro. And so I want that Logitech gaming mouse in their hands, or that Turtle Beach headset, or that Coca-Cola, or that, you know, Taco Bell, you know, product in their hand. And because I think so many brands now realize that such a large segment of their population are gamers, we've kind of gone from the last few years of an education to now being able to start to show how we really monetize not just the gamer, but also all the content that we're generating.
What's the potential for this industry then, both in China and globally?
If you look at it and you say that just 10% of the 2.6 billion gamers out there do want to participate in esports, you know, if you think about it, basketball didn't start with the NBA. It started in the cul-de-sac, on the driveway, in the local park, and that's where all of great sports start. And if just 10% of those gamers want to participate in that, and let's say that you can monetize them at $5 a month, you're all of a sudden looking at, you know, a 20 billion plus market category, not a 3 billion. So our argument would be is that people don't really know yet how to quantify the value of esports, and the 3 billion projection is merely just a professional level projection that doesn't speak to the everyday person who aspires to compete.
That was Super League Gaming CEO Ann Hand speaking with Bloomberg's Sherry On and Heidi Stroud-Watts. Now, you could call it a dream team. Activist investor Dan Loeb, Chinese billionaire Jack Ma, and Silver Lake are joining forces to bet on the business of luxury shoppers' tax refunds. The investors are putting $1 billion into merger between Farpoint Acquisition and Swiss payments company Global Blue. Tom Farley, Farpoint's CEO and chairman, sat down with Bloomberg's Vonnie Quinn, Shanali Bosick, and Guy Johnson on Bloomberg Markets.
We're valuing this business at 12 times forward enterprise value to EBITDA. It's quite a conservative valuation for a business that's growing 8% year to date organically, all organic, 42% margins, highly cash generative. If you compare it to comparable companies, other integrated payments companies like an Edenred, WEX, FleetCor, or the big payments companies, it's a significant discount. But the equally interesting thing for me is just thinking about the strategic possibilities for the business. I mean, you mentioned it, luxury travel, consumer data, the ability for more consumer marketing, just the cross-border payments nature, which is the most lucrative area of payments. I mean, this business is right in a sweet spot for us and for a fintech SPAC like us.
Well, if I'm not mistaken, the last time you were with us, almost 2 years ago at this point when you started this, you had mentioned that you would be able to do something with 10 to 15 billion in enterprise value. This is 2.6. Do we see more acquisitions ahead to grow this firm?
Yeah, it's interesting. When I was here a year and a half ago, I was thinking about it as I was here in the green room. We thought, we went on air and we said, look, we want to do a fintech business, got to have a little bit of growth, structural growth, something we can create value for investors. And then Vonnie, when you were introducing it, I never imagined we'd have the dream team lined up of Jack Ma, of Silver Lake, a premier, maybe the premier technology investor, Dan Loeb, also the CEO of the business, Jacques Stern. To answer your question directly, Sonali, yes, M&A is certainly part of the strategy, but the beauty is the business is growing, so we don't have to do M&A. We can be very opportunistic. Both Jacques and I have run public market M&A plays that have made lots and lots of money for investors and been helpful to our customers, so that will be a part of the strategy, and we think Jacques has positioned the business so that it will be able to do that.
You have some very powerful co-investors here. You have Dan Loeb, you have Alibaba Ant Financial. What do they bring to the table?
Yeah, actually, let me just enumerate them. So it's Ant Financial, $125 million, hugely strategic business, perhaps the most impressive financial technology company in the history of the world, for those who follow it closely. Ant Financial brings tremendous expertise, and also they bring a customer base, that Chinese customer base that's growing and growing and growing, traveling more and more, shopping luxury more and more. Third Point is investing an incremental $100 million. So Third Point already has a significant investment in Farpoint. They're putting in an incremental $100 million, and additional investors are putting in another $125 million. So new investors to Farpoint, some existing investors putting more money up. So when you tally all that up, it's $1 billion investment, a real validation of this business and the deal that we've struck.
This is the second major fintech acquisition we've seen this week. What is Wall Street not getting about technology that is making these up-and-comers really rise so quickly?
Well, I think, look, fintech is hot. We're seeing it everywhere in fintech. It's payments, it's connecting banks in the case of Plaid, it's consumer marketing in the case of Honey selling to PayPal. That's the exact reason why Dan Loeb agreed to partner with me in the first place when we set up this SPAC. I mean, that guy's a pretty smart guy for 3 decades, among the smartest stock pickers in all of Wall Street. And it's precisely because fintech is probably the best area to invest in all of finance right now.
Tom, Guy in London, I've seen their kiosks down at Harrods. I've seen them at the airports here in the UK. But as you say, I find fintech is super hot right now. Any resistance from these guys about going public? It hasn't exactly been the greatest year for tech companies going public.
No, not at all. Not at all. So, Silver Lake's been excited about it the entire time. The CEO, Jacques Stern, has been excited about it. Look, part of it is these are public markets people. Jacques ran Edenred for 6 years, 2009, 2015. Tripled the stock price while he was there. Silver Lake has many investments in public companies. They had Sabre for, a decade, SolarWinds now, many others. They viewed being public as quite helpful for a variety of reasons, one of which is to have an additional currency, potentially to do acquisitions, tuck in strategic acquisitions. But no, there really wasn't a resistance to going public whatsoever that I picked up.
That was Tom Farley, Farpoint Acquisition Chairman and CEO, speaking with Bloomberg's Vonnie Quinn, Sonali Bosick, and Guy Johnson. And that does it for this edition of Bloomberg Technology. Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.